All right, Daniel Clayman here. I wanted to record this training for you in case you have interest in building new construction rentals. This is called Build to Rent Funding for Duplexes and Small Multifamily, how to get up to 100%. So I put this different training. This is the original training I put out a few months ago called 4 Duplex Built to Rent Case Study, how one deal replaces a $40,000 a year job for life. This was a case study of 4 duplexes. They look like quads on the outside, but there's a difference that I built. And at the time when I was recording this case study, I had just started construction on them, but it's been a very popular training. It's been viewed at this point over 21,000 times, which is nice. And I'll link to that original training here because it goes into detail on how to build new construction rentals. But this is a video that I am recording as a follow-up where we're going to go deeper into how to fund these deals. My name is Daniel Clayman. I live in Richmond, Virginia. I build real estate. I build software for real estate investors, and we typically do infill development, which means that we don't develop new subdivisions or do development in rural communities where we need to bring in new utilities and new roads. Rather, we develop in urban core where we take existing building lots and we put duplexes, quads, multifamily, mixed-use buildings. This is that project that was in the original training. We just finished it. It's fully leased. The numbers came out much better than in my original assumptions in that training. This project turned out amazing, but this is typically the type of deals that we do. Mixed-use buildings, corner commercial, townhouses, all the way up to large apartment communities. This is one that I'm getting ready to do here in a little bit. So why am I doing these videos? First of all, nobody's teaching true wealth building. Nobody's teaching real estate development or how to build real generational wealth. And especially nobody's teaching this for free. There are a million gurus on YouTube or on Facebook that will teach you how to wholesale houses and how to flip houses. And that's great. Those are great strategies, but very few people are teaching real wealth building, the stuff that allows you to truly create time freedom for yourself. Collect the monthly checks on your rentals and not have to do new deals. And I had to figure this all out when I was getting started and on my own. And I wish personally that content like this was available to me when I started. Secondly, to follow up on that point, real estate ownership, whether it's done through acquisition, you don't have to do new construction, right? Real estate ownership in some form and long-term ownership of real estate is where bulk of real estate wealth is always built. It's not by wholesaling or flipping. It's just not. And third, my second business, in addition to real estate development, provides cutting-edge tools to investors and developers that shortcut your ability to analyze development projects and raise money for them easily. There is a free version that I'll give you access to, and this is another way that we empower investors like you. So I want to dive deeper into how to fund new construction rentals, and I'm specifically going to be talking about the debt financing in this video. Private money is a separate topic, and we can cover that in a separate training. I'm going to dive deeper into how to fund these rentals, how to fund the debt portion. I'm going to show you how to get short-term funding for your deals, how to get permanent financing, how to get all-in-one loans that go from construction to perm, which is nice because you don't have to refi. We're going to talk about massive advantages when it comes to leverage in new construction. This lets your cash or your investor's cash or your partner's cash go a lot further. And we'll talk about why BRRR, this is a variation of the BRRRR that you're probably familiar with, but this is Build, Rent, Refi, Repeat. This is the new construction version, is a great strategy. So we're going to look at 3 scenarios in this training. Scenario 1 is your typical acquisition of stabilized assets. A stabilized asset is a building that's already either built or renovated and occupied with tenants. So in a typical stabilized asset acquisition, you're going to need to come up with about 20 to 25% equity, and your debt is going to cover the remaining, typically these days, 70 to 75%. So construction is scenario 2. Your equity requirement is, and I'll show you why, but your equity requirement typically will be lower based on the value of the building and based on cost as well. In scenario 3, which is the build, rent, refi, repeat, you're able to pull most of your equity, if not all of your equity, and i.e. cash, back out. And so your effective equity in the deal ends up being 0 or close to 0, and your debt covers almost all of your cost. And I'll dive into detail into each one of these scenarios here in a second. So let's look at scenario 1. Let's say there's a 6-unit apartment building that you're going to purchase for $1 million. It's already built. It's already stabilized with tenants. You're going to need to come up with typically 20, 25, maybe even 30% down. Depending upon the kind of financing that you're able to secure, you're on average going to need about $250,000 to $300,000 in cash, and your debt is going to cover the balance. In new construction, let's say there's a building that will be worth $1 million when it's built. You're going to create sweat equity by building it, first of all. So let's say you're going to buy the land for about $100,000. In some markets, the land may cost you more. In some markets, you may be able to find land for less. I recently built a 6-unit building that is worth right around $1 million, and I paid $78,000 for the land. So these are very realistic numbers depending on your market. But you're going to pay $100,000 for land, and then you're going to take out a bank loan for $700,000 to build it, and you're going to end up with $1 million asset. Here's how the numbers stack out in this example. For the purpose of this scenario, we're going to assume that you pay cash for the land. Now, that cash doesn't have to come from you. It can come from a partner. It can come from a private lender. It can even come in the form of seller financing by the seller. But you're going to pay $100,000 for land. You're going to have about $50,000 in closing, holding, financing costs throughout the project. And it's going to cost you $700,000 to build this asset. So your total all-in cost is going to be $850,000. Now, this is a conservative scenario. This assumes that you're going to create 15% sweat equity in this deal. We typically aim for 20, even 25% sweat equity in our new construction project. So I'm giving you conservative, very realistic numbers. Well, you're going to be able to take out a bank loan for $700,000 because it's only 70% of the value of the building. You're going to invest $150,000 in cash. So your effective equity is going to be 15% of value, right? $150,000 is 15% of your value of the building instead of having to put 25% down. And if effectively it's 17.65% of your total project cost. So again, instead of putting 25% down, you're putting in 15% of the value and only 17.6% of the total project cost. So already you're able to achieve better leverage than by buying an existing building, and you're creating sweat equity. So that's pretty good, right? Now you own the same asset as scenario 1, but you've only invested $150,000 in cash versus $250,000. And you've got 15% sweat equity versus 0. So this is a very strong case for going through all that effort to build new construction, right? It takes longer. It's more work than buying something stabilized, but you're able to build in and generate not instant. When the building is done and it's leased, you're creating wealth. You're not waiting for appreciation to help. And it's new construction. It's well designed, it's well built, it's easy to manage, it's very low maintenance, it's an attractive product that's easy to lease, easy to own. So let's look at scenario number 3. This is where you're going to build this and you're going to refi out of it. So again, $1 million value, $100,000 land purchase, $700,000 construction loan, $1 million appraisal. Now you're going to go and you're going to get that $1 million appraisal once your tenants are in the building, and you're going to get a new loan for 80% of that value. This is going to be your takeout slash perm financing. This only leaves $50,000 in cash in the deal on a long-term basis. So now your equity is only 5% of value or 6% of your total cost. That's a lot better than 25%, right? Leverage here is far greater than in the first scenario or the second scenario. So now you own the same asset as scenario 2, but with $50,000 in cash versus $150,000. You still have 20% equity on your balance sheet. And look, with the right deal, it's absolutely possible to pull out all your cash. But given the new construction costs right now, and they're going up, it's getting harder. So I want to make sure I'm giving you realistic numbers here to hit and not some pie in the sky. Okay? So that seems easy to wrap your head around so far, right? And if not, go back and rewatch this. But let's talk about where to get the money and the constraints that you're going to face when getting that money. So for smaller build-to-rent projects, typically $3 million and under, we go to local community banks for construction loans. Even though you can get construction loans for much larger projects from local community banks as well. We're doing a $5 million project now and getting ready to take a $20 million project to permitting as well. And we're going to finance construction with a local lender because we have an existing relationship. They know us, and the underwriting requirements are clear. And compared to getting HUD or VHDA or anything similar, the process is simpler. So for these projects, local community banks are a great source of construction loans. Often these loans, the benefit of these loans is that they can roll over to what's called a mini perm without the need for a separate refi. So you get a construction loan. It's interest only for 6, 12, 18, or 24 months during construction and lease-up period. And then it converts automatically to a fully amortizing loan at same or, depending upon how you structure the deal, a different interest rate, either with a 20 or a 25-year amortization. So the benefit is that you do not need to refi. It converts into permanent financing, and it's called a mini perm because the rate is typically not going to be locked in for 30 or 20 or 25 years. Rather, because these are commercial lenders and they don't give out fixed rate loans, right? So there's going to be either a call or a balloon or a reset after 5 or 7 years. So there is some interest rate exposure here for you if you choose to go with this option. The balloon is one of the reasons why you may want to refi out into longer term financing after the construction and lease-up period is over. The other reason is to pull out some or all of your cash invested. The constraints on how much your lender will give you for construction will be as follows. Though again, all local banks are different and have different lending criteria. They may cap you at the percent of total cost, not to exceed, for example, 80 or 85% of cost, right? Land plus construction. Loan to value, based on as-built value, max, let's say 80%. Oftentimes, what they will do is they will say, we will give you the lesser of 80% of as-built value or 80 or 85% of cost, for example. And then you're also going to be capped by the debt coverage ratio of the perm loan once the building is built and leased. So this is a big constraint and will usually cap your numbers. And we'll look at an example. Let's say, again, you buy the land for $100,000 with cash. Your construction budget is $650,000. All other costs, closing, holding, financing costs are $50,000. So your all-in cost is going to be $800,000, and stabilized as-built value is $1 million. This is right where you want to be because you're creating 20% equity, 20% sweat equity, right? This is a little bit better than the earlier example I showed you, where your total all-in cost was $850. $800,000 allows you to basically create $200,000 worth of wealth, which is your reward on your balance sheet for going through the effort to find the land, go through design, permitting, and construction process. You're going to get a construction loan, which is going to be as follows. It's a max of 80% of your cost or 75% of as-built value, whichever is lower. And it's going to be a 12-month interest-only loan at 4%, and then it's going to convert to a mini-perm at 4.5% with 25-year amortization. All right, so what does that look like? 80% of cost is $800,000 times 80%, that's $640,000. 75% of as-built value is $750,000. So your cap is going to be $640,000, but there's a debt coverage ratio minimum of 1.3. So let's calculate that. That means that when this property is built and rented, net operating income must be at least 1.3 times the mortgage payment. So while the loan we previously calculated was $640,000, which is nice, it's almost the entire construction budget. If a $640,000 permanent loan can't be supported by the net income of the property, you'll need to reduce the loan amount down until you hit 1.3. So how do we calculate this? It's a 6-unit apartment building, $1,100 a month, times 6. That's $6,600 a month. We're going to assume a 35% operating expense ratio, which is pretty standard, 30 to 40%. If you're in that ballpark, that's right where you want to be. So your operating expenses will be $2,310, which leaves a net operating income of $4,290. Your permanent loan will be 4.5%, 25-year amortization, with a payment of $3,557. And so if you take your NOI and divide it by your debt service, you're going to hit a 1.21 debt coverage ratio. Unfortunately, that's not enough. So you've got to bring your loan down from 640 and keep bringing that loan down until it hits 1.3 debt coverage ratio. All right, so bottom line is you have to build profitable deals. Your lender doesn't want to fund something that won't produce enough income to cover your debt. All right, so is this starting to get a little overwhelming? Okay, well, fear not, we have the solution. If you don't have Rehab Value yet, I'm going to give you ability to do all of this deal analysis for free. Full deal feasibility, rent roll and pro forma analysis, short-term financing analysis, permanent financing analysis. I'll demonstrate for you in just a second exactly how to do it. You're going to save tens of hours of work. You can fire your expensive analysts that you pay to figure this stuff out, or you can teach them how to do this. And most importantly of all, you can avoid doing bad deals. We also going to give you detailed lender funding proposals. Those come with a premium version of the software, and I'll let you test drive it for almost nothing. These have been responsible for tens of millions of dollars raised by my clients and myself as well. And there's a full project management suite that we'll give you access to as well. That comes with the premium version. You can put together detailed construction budgets, cost templates, scopes of work, project schedules. There's in-app accounting, full reporting for your lenders, for your partners. So let me show you how this works, because this is going to make your life insanely easier. Okay, so I'm in my account. I'm going to click Start New Deal. And I'm going to show you how easy it is to model this out and then to raise money for it and do everything else. So we're going to ignore this screen for now. This actually allows me to pull in full owner and property data instantly from public records, but we'll ignore that for now. I'm going to switch this to construction. I'm going to put my cost of land here at $100,000. I'm going to zero out these costs for the purpose of keeping things clean. And then I'm going to click construction budget. And I've got ability here to build out a detailed budget. I can load in my templates. But for now, I'm just going to put in my total cost of $700,000. And then I'm going to go here and I'm going to click on rent/BRRR, and I'm going to enter my projected operating income for this building once it's built. So per our example, there are 6 units, they're 1 bedroom, they're about 800 square feet each, and they're going to rent out for $1,100. And I can use this screen to model out anything from a single family house to a 5,000 unit apartment building. And I can make this as granular and as detailed as I want, and I can input my income monthly, annual. I can export everything to Excel. So I'm going to leave vacancy at 0 for now, though your lender will require you to model some vacancy rate. And then I'm going to click into operating expenses. And again, I can enter detailed operating expenses here, as many fields as I want. I can enter them dollar per unit per year, monthly, annual. But for now, I'm just going to enter a plug based on our example. Of 20, what was that number? 2310 per month. That's our operating expenses at 35% of gross income. And that leaves me with a $4,290 monthly net operating income. My as-built value is $1 million. And here's a cool tip for you to figure out if your projection for your as-built value is accurate. Based on my net operating income, the software will automatically compute a cap rate based on your cost and based on your as-built value, or ARV. So $1 million of value, you're roughly at a 5 cap, which for new construction in this market is right on the money. So what I need to do now is go into my financing analysis. I've got my purchase price of land, I've got my cost, including my holding costs here, I've got my as-built value, and I've got my net operating income when the property is built and stabilized. Now I'm going to click into financing. And if you remember our example, we were able to fund 80% of cost at a 4% interest rate. So I'm going to go and I'm going to enter that here. 80% of cost, 1.4% interest rate. Yes, we have to make interest rate payments during construction, and my construction will take 8 months. We're going to give ourselves 4-month lease, and so now you can see my construction loan is $640,000. And now what I need to do is I need to model a refi into permanent financing. So because there's not an actual refi that happens, this is a loan that converts to mini-perm. I need to enter the percentage of ARV here that will give me a permanent loan of $640,000. So that's 64%, right? $640,000 is 64% of 1 million. Now, the cool thing about converting to mini-perm is that there is no closing costs or fees of any kind. And my rate is going to be 4.5%, amortized over 20 years. And there you go. My monthly payment is $35.57. And just as I showed you in our example, and you can refer back to the slides, you can see that my cash flow is going to be this. My cash and cash return is this. It's low, right? I'm leaving $192,000 in cash tied up in a deal. But the problem is my debt coverage of this permanent loan is 1.21. So I have to scale back. So I have a couple of options here. This is important. I can scale back my financing, or I can get more aggressive on my performance. So if I scale back my financing to, let's say, 60% of value on my perm loan. That gets me to almost a 1.3 debt coverage ratio, which is where I need to be. But here's the bigger issue with this deal. I'm leaving $232,000 tied up in the deal, and my cash on cash is only 4.9%. That is very low. So how do we turn this into an attractive deal? Well, instead of building 1-bedroom units, I need to figure out how to fit 2-bedroom units here maybe, right? And rent them out for $1,400. Now that might require me to increase the footprint of the building a little bit and increase my construction costs, but let's ignore that for a second. And let's assume that I'm able to do 2-bedroom units here at $1,400 a month. Now look what happens. Let's go back to just the mini perm loan. 64%. So the construction loan is $640. Permanent loan is $640. I'm leaving $192,000 tied up in the deal. But now my cash on cash return on that $192,000 is 16% off the bat with a 1.71 debt coverage ratio. So what can we do now? Guess what? Now we can do a real refi and pull out some of our cash. So instead of converting it to a mini perm at $640,000, what if we get an 80% LTV loan? If I change this to 80, I still have a 1.37 debt coverage ratio. I've only left $32,000 in cash tied up in the deal, and I'm generating a 61% cash on cash return. That's insane. So look, my payback on that 32 grand that I've left in the deal is 1.62 years. I'll get that cash out in less than 2 years. That's insanely powerful. And being able to do this analysis before you even buy the land is pretty powerful as well. So I just walked you through the second scenario in our example and the third scenario. Let me show you what we sent to our lenders in order to secure this financing. Let's assume that this was just going to be a construction loan plus a mini perm rollover. This is what I will send to my lender. So I'm going to click reports, and this is what I'm going to select. And I've already entered a little bit of information here to save us time, but I'm going to select executive summary, marketing sheet hold, and income and expenses. And I'm going to click generate. And then I can click get unique link, and the software will create a unique web page that I can then email over to my banker. Or I can generate a PDF presentation and email over. But it's going to have a very simple executive summary where I can write about the project and I can write about my company, and we can fit a lot more text in here. I just did this in a hurry. And then you're going to show them financial projections. So, as built value of $1 million, I'm buying land for this much. My total construction costs, this will be my short-term construction loan. Between land and additional costs, this is how much cash I'm putting into the deal. This is the projected net income, or I'm sorry, gross income, operating expenses, net income, and then this is my timeline for how long I need before I can roll over into a mini perm, and I will roll over into the same $640,000 loan, and the permanent loan will have a 1.71 debt coverage ratio, right? With these assumptions. So this is what we use to raise millions and millions of dollars from our lenders. We send them this, and then we send them a pro forma. Now, in this case, I did not fill out my pro forma in detail, right? The lender will want to see a vacancy rate modeled here. A lender will want to see all your operating expenses itemized here, and you can easily do that. But this is what we send to our bankers. So what I showed you, the analysis part is available in the free version. The financial reporting is available in the premium version. The other part of the software that is insanely powerful is the project management suite. So here I entered a lump sum ballpark figure, but if I go to detailed input, I can preload one of my pre-existing new construction templates, and I have multiple of them saved. I have in the software ability to store all of my bids. Let me show you a deal that I just finished building. This is an 8-unit project that I just finished. And so in this software, I've got all my costs pre-populated. I've got all my bids stored. I can click and I can pull up all of my bid documents. I have This is a full-scale construction management software. I have a detailed schedule that I can update in real time in order to run this project. There's in-app accounting here that allows me to store very easily all of my transactions and then track my project in real time. Budget versus actual. And I can very easily audit. Everything is exportable to Excel or PDF. And I even have ability to do lender draw requests here with the software. You click a button and you generate a construction draw request to send to your lender, like this. This software allows you to do deal feasibility, raise funds, and then manage this project start to finish. In addition to this, there is full reporting here, and I can include detailed budgets to send to my lenders. One of the things that my lender will want to see is a detailed itemized budget for how we're going to build this project. And so I can send a full scale budget to my lender. I can create reporting that shows me exactly where I went over budget, under budget, or during the project it'll tell me who I've got left to pay and how much. I can create post-construction project summaries to send to my lenders, to my partners, etc., etc., etc. I hope this has been useful. Leave me your comments, questions, feedback below. If you're able, share this on social media and with your real estate friends, with whoever you think might benefit from this knowledge. Not many people are teaching this. And if you don't have Rehab Validator Premium, now you can create a free account if you go to rehabvalidator.com if all you want to do is just do the deal analysis. If you want the funding, proposals, ability to raise money, and the full project management and construction management suite, take this software for a test drive. It's just $1. You can go to rehabvalidator.com/try. You'll get full support, detailed tutorials. We do fast track webinars. You'll be in great hands. You'll get the full funding presentation suite, full project management suite, and much more. And go build something.